What is going on, everyone, and welcome to the channel. So in this video we're going to be going over how to trade options on Webull. Now I wanted to make this video because as the time it's coming out, Webull has recently updated their platform and we're going to be diving through the desktop platform. Now a lot of the same features you will also get on mobile, it's just going to be a smaller view, but Webull's platforms when it comes to the desktop, the web app, or the app are pretty much in sync. So what we're going to go through here is we're going to talk about trading options, right? So when we talk about trading options, the first part of this video I'm going to go through an introduction. Then what I have is my Webull platform open right here, and we have the option chain up for a specific stock. So we'll talk about this here as we get going. I promise I'm not going to just have a slideshow. It's going to be a couple things that you guys have to make sure you understand beforehand. Then we'll go into this and we'll talk about what they have here. So if you already are new to this, I'm going to have timestamps down below. So check out those timestamps because they'll be helpful to navigate to these parts that are pretty cool and that you may want to know more about. So basically when it comes down to trading options, there's something called a call and there's puts. So you have calls and puts, and you have the ability to buy and sell both calls and puts, but for the most part, what you're doing when you're trading options, if you're coming to this video looking for a way to take a smaller amount of money and multiply that or achieve larger percentage returns. Let's say if you're trading a stock like Apple and Apple only moves, 1 to 5% in a day, well, you can trade Apple options and you could make significantly more than 1 to 5% per day, even if Apple only moves that much, because the option premiums are much more volatile. So you can make more, but you can also lose. So I want to talk about that as well. Now, buying calls and puts is what we're pretty much talking about here. I have some more videos on the channel going over selling calls, selling puts, the Robinhood wheel strategy. It's really not necessarily just for Robinhood, but it's a cool strategy that you could really earn some extra income by holding positions that you already like long term. So go check those out at the end of this video if you want to learn more about selling. This video will primarily be about buying calls and puts, and I'll mention or I'll talk about selling briefly. So calls is pretty much betting on the stock going up, and buying a put is betting on the stock going down. Now, of course, there's things like strangles, straddles, and all these different things, and different strategies, spreads, and all these different things you can do, but pretty much the basics behind this is you have the right, but not the obligation, to purchase or sell. Now, purchase for calls, sell for puts, 100 shares of the underlying stock, let's say you're talking about Apple options of Apple, at the strike price. So here's the strike price. It's the price that you're buying the right to purchase 100 shares. So really quick, going over here, we have this strike right down the middle, and that is the strike price. So we see, so what Webull's telling me right here, and sorry if it's a bit small, but what we're seeing right here is that this stock, SPAQ is a ticker symbol, is currently at $14.60. It was up 66 cents the last day, which was 4.73%. I am filming this video after hours, and options trading is only allowed from 9:30 a.m. Eastern to 4 p.m. Eastern. You cannot trade options after hours or pre-market hours. Just understand that going in because people always ask that question. It's inevitable. So when we have the strike price right down here, and we have a 6D, which means 6 days until expiration of this strike, and I'll talk more about that here in a second. And it's October 16th at the time that I'm filming this video. So we have these strikes, then you can go out to different expiration dates of November 20th. So that's what you're going to see on the left-hand side, the expiration dates and then the strike price right here. Now the expiration date is when this contract will expire. So when you're trading options, you're pretty much trading the premium, which we have right here. You're trading the option premium. If the premium, let's say you buy it for $1 and the premium goes up to $2, well, that's 100% gain on that premium. So most people when they're trading options are either going to be short-term trading options, you might have long-term options, you can do a bunch of different things. There's so many strategies that you can utilize. There's not one specific way that you must go about it. But when you're trading them, the strike price, the expiration date, and the premium are probably the most important things you must understand and why they are the way they are and how they work. And we're going to talk more about that here as we get going. Now, another thing is in versus at versus out of the money. So you're probably going to hear these terms or you'll see them kind of like this, like ITM, ATM, or OTM, and that's what they stand for. So going back to Webull, going back to this. So what this is really cool is that it tells me, right, this stock price is $14.60. And these strike prices, so we're in between. So it shows the stock price in between where it actually is compared to the strike prices. So let's talk about calls really quick, because what we currently have is we have both. So on the left-hand side, I know it's kind of confusing when you're first seeing it. We're going to be seeing calls right here. On the right-hand side, it's puts. So these are put options. These are call options. Now, when you see that they are green, that means it is in the money. So see, these are green in the money, these are green in the money, these are not, these are just, black or gray, these are just black or gray, these are out of the money, these are out of the money. Now we see that it's opposite for calls and puts. Why is that the case? Well, let's say your strike price is $15. Let's say you buy a $15 strike price call, right, which right here we have the bid, we have the ask, which we'll talk about as well. So we have the bid and the ask, just like any other stock, which is between 70 and 75 cents. So let's say I want to buy this and I pay at the ask and I pay 75 cents. That's going to cost me out of pocket 75 cents times 100, because we're talking about 100 shares of the underlying stock. So that's going to actually cost me $75. So I pay $75, but this contract is currently out of the money. Why is that? Well, to be in the money for calls, the strike price must be under the actual stock price. That will generally lead to more value. Now, you can have situations where the option contract, even out of the money, is still very expensive in your eyes, but it's going to be more expensive when you're in the money as you have more intrinsic value, and I'll talk about that here as well. So intrinsic value, what we're talking about is, let's say we had these $10 strike price options. Right now, the intrinsic value on these contracts is going to be the stock price minus this price. So let's say the stock is sitting right here, which it is, at $14.60. We take $14.60, we subtract the 10, that leaves us with $4.60 of intrinsic value. And if these contracts are priced higher than $4.60, what is that telling me? That is telling me that there are other factors at play here, volatility and time. Now, the less time you have, the less kind of expensive the options are going to be. As the more time you have until the expiration, the more expensive this is going to be. So let's just show you guys an example, right? SPAQ, $10 calls, we're looking at trading between $4.70 and $4.50. They should have a value, they should have an intrinsic value of at least, or of $4, not at least, of $4.60. And this extra 7 cents, as this was the last, is factoring in for things like time and volatility, as we have one more week until this expires. If I move out to the 20th, November 20th, and I look at the same exact contracts, what we're seeing here is that they actually cost more money. Now, that makes sense as there's more time until we hit this expiration date, but they don't cost significantly more. Certain more volatile stocks like a Tesla, potentially even Apple for calls, you may see this cost significantly more. In this case, it's only costing a couple cents more, which equates to only a couple dollars more. And to you, as you always have to multiply this number, the bid or the ask, which we see this last, this is the last order that went through, multiply that by 100 to actually calculate your out-of-pocket or out-of-account cost. And like I was saying with this intrinsic value, a strike price above the current price of the stock actually has zero intrinsic value. So if you do the math here and you take the stock price and you subtract the strike price, you're going to get a negative number. Now, option contracts are not actually valued at negative amounts. They are not. They never go negative. You cannot have a negative option when you're just buying calls and puts. But why is this still going to cost you about 70 cents? Well, the reason why is, again, like I said, you have the time and you have volatility. So you have a stock that's not super volatile, but there is still decent time on this option. So there's still one more week, and the stock moved up 66 cents today. So what's to say it can't move another couple, dollars over the next week, which is why we still have this price right here. One other thing to make sure you always pay attention to, and I think it's very, very important, is always look at this open interest column. If the open interest is not at least a couple hundred, that's something you're going to want to stay away from, just because that means that there's not much interest in these contracts. Like, for example, the $2.50 strike price, no one is caring about those, but you start looking at higher level strike prices, or you look closer to the money and you'll see this. So when I say closer to the money, again, that means that it's closer to where the stock is. So this is currently in the money. This is currently below the stock price for a call. Now for a put, it's opposite. So for a put, if you want to get in the money, you want the strike price to be higher than the stock price because you're betting on the stock to go down. So the further the stock falls down, the higher in value your put contract is going to be. So let's say you buy the $15 puts If SPAQ goes to 14, goes to 13, goes to 12, well, that's going to have at least a few dollars of intrinsic value. And then if there's still time, if there's still about a couple days or a week or so until the expiration, you also have to add in a little bit of time and volatility to that price. So hopefully this is starting to make some sense. So I know it could be complicated to some people, but hopefully it's making some sense. So like I was mentioning, time and volatility is the biggest battle when it comes to your options trading. They both have a positive correlation. So the more time there is until the expiration and the more volatile the stock has been or traditionally is, then the more you're going to see the option premium cost you. So that's pretty much it for the slideshow. So I didn't have much there for you guys. I didn't want to bore you with that stuff. But hopefully that's starting to make some sense. So now we have this. Now the really cool thing that I want to talk about when it comes to Webull's platform, which is different and it's a little more advanced than Robinhood. So let's say we're looking at these $10 calls. So what I'm going to do is I'm going to click on it. And then it's going to come to this order entry thing that we see right here in the middle of the screen. I can actually make this a little bit bigger just so that for the purpose of this video, we can see this a little bit better. Now I can even put it here. So now I have this tab. This is a bit more advanced. So if you don't know what just happened, I have a video going over how to create a custom platform, a custom layout on Webull like this. So we have the option chain, we have the order entry, so I can overlay those two widgets. Now, this is going to be your order entry. So this $10 strike price, October 16th expiration. Make sure the ticker symbol is the same. You click on buy. We're looking at, let's say, 10. Now, I don't know. 10 is going to be a lot because here's the thing. You have to multiply this by 100. So it's going to cost you $470 as it is. Add 10 to that, that's going to, times that by 10. So that make sure you don't, you have this quantity in check. Many times if you're starting out and you're just learning, you buy 1 to 2, maybe 5 to 10 contracts depending upon the price. Now what I want to put your attention to is this down here. So what it's going to tell you guys is the amount. So it's going to tell me it's going to cost me $470 and my max loss is negative 470. Max profit is unlimited. So that is what I want to really kind of hone in on now when it comes to options. And Webull has this other feature. So on the bottom of this widget, of the order entry widget for options, there's a table and then there's a graph. So you can come here and actually enter your order in through here on the same thing, but here's what I want to share. So this is going to be kind of confusing when you're someone who's just starting out, but it's also an amazing place to learn. If you just want to come in and kind of get a better understanding, download Webull Desktop, sign up for your account, get 2 free stocks. Link will be always down below to do so. And then start messing around with this order entry, right? So currently the price of the call is $4.70. So it's going to tell me that, I'm going to have to pay $470 for this. This red is going to be showing the negative. So if SPAQ stock starts going down, my max loss is $470. Now, what I will tell you guys is this: be very, very careful with this. Just because you see this is going to be kind of confusing, and it could be, a little bit difficult to understand. So let me scroll across here to show you guys. Your maximum profit is essentially unlimited. The stock can technically go to infinity. But worst case scenario, the stock goes to 0 or the stock falls under the strike price, you're going to be in the red. Now, a very important component to this is that this is telling you, this graph is pretty much just going to be telling you the intrinsic value of this option on the expiration. So it is only factoring in, so you're paying $470, so that's why this kind of break even is that this stock needs to be at $14.70 come the expiration for you to get out for break even. Now that means because you paid $4.70 for the contract, so the stock better be $4.70 or more above the contract strike price by the expiration for you to get out at least break even. But I will say is that the stock price could still be lower than what they're saying here, or it doesn't have to line up perfectly. Okay, so the stock price, if all of a sudden the stock price in one day shoots to $16, $17, well, you may say to yourself, the contract goes up $2, I'm going to make $200 profit. Well, you also have to factor in that there's still time, there's still potential volatility, so there probably is going to be a little bit higher. And just because it's telling you that you're going to have a max loss of $470 if we do fall below $10, if SPAQ was to fall below $10 the next trading day, there's still going to be value to that contract because there is still time and there's still the volatility factors that go into it. If SPAQ was below $10 at the end of the day, within like 5 minutes of the market closing, yes, you probably wouldn't be able to sell that contract for any money. And if you do, maybe you can salvage 5 cents at best. So I don't want you to get caught up and confused with this chart. It's actually very, very beneficial to help you, but it's really going to be great for the intrinsic value and understanding that when you pay and buy an option, buy a call, buy a put, your only max risk is how much you bought it for, because worst case scenario, the option goes to zero, which means it expires with no intrinsic value at the end of the expiration date, which is the 16th in this case, and it expires at $10 or less. That would expire worthless. And one other thing to note here is that when you're trading options, most people are just trading the premiums. Actually executing your option or your right to buy these 100 shares at a price, at the strike price, most people don't do if you're looking to trade options in a way where you are looking to buy and sell a premium and make money off of that premium. So selling before the expiration is what you want to be doing. Now let's go through a put example. So we're going to be going through a put example right here. So we're buying $15 puts. So currently the price is below, and it's telling me right now that if I wanted to buy, let's say I wanted to buy one contract, boom, let's simplify this guy right here. One contract, it's going to cost me 120 bucks, which means this is going to cost me $1.20 as of right now. Here's the stock price. The stock price needs to go lower for me to make more money, and worst case scenario, if the stock price does go above 15, I will have a zero value option come the expiration date. Come the end of the day on the expiration date, if it does push above 15 and I want to cut my losses, cut them before the expiration date, you at least will be able to get out with some salvage value, unless some people like to play options where they play a couple different options. Worst case, they're playing more like lotto options. They're playing cheap options that are worth maybe $1 or maybe $2, or maybe even, sometimes 20, 30 cents. And if it expires worthless, it expires worthless, or it makes a good run and that 20 to 30 cents turns into $3, $4, and it makes a massive move, and many people can play options that way as well. So again, here on for puts, when you're buying puts, you're going to make money if the stock price goes down, selling that put for more money as that stock price does fall. Same thing here, the max loss is what you paid for it. So that is the worst case scenario. Now really quick, let me talk about selling. So if I was to come in here and I was to click on this and I click on sell, I could sell these options right now as well. Now, when I'm talking about selling, I have a video going over this more in depth, but when we talk about selling options, so what actually happens means if you're selling, you're going to be getting money for that option. So again, let's say we're going to be selling let's say the $25 calls, because this is what I've actually done for this date in my other account. And I have a video over this if you guys want to see this more in depth. But what I did was actually a couple weeks back, these were worth $1.75. So essentially one contract meant that if I sold one contract, I would get credited $175. That's what happens. You get credited. Now, I would recommend, and this is selling covered calls, means you have to have 100 shares of the stock to do this in many different brokerage. So what you're going to do is you have 100 shares. So I had 100 shares in my other account, and I sold the $25 call. So now what happens here is that worst case scenario, not worst case scenario, but there are multiple scenarios here. The stock price could just sit where it is or fall lower. Now, I have 100 shares, and that's fine. It goes down. You want to be doing this on stocks you're willing to hold longer term. So that's kind of the key here. So if it does go down quickly, are you going to be concerned about cutting losses? If so, you make sure that you understand that. Now, I sold these. I got $175 in credit. Now, what happens is if SPAQ was to go above $25 and somebody executed that option that I sold, well, then I would be required to sell them my 100 shares of SPAQ at $25. So I still had an average of SPAQ at like $13 or $14. So I would still capitalize on nearly 100% gains of the stock price. On top of that, I was credited $175 for selling that right, for selling that option to somebody. So as long as this option expires out of the money, right, which we are currently out of the money, we still have a lot to go, right? We have more than $10 to go in a week. It's probably not going to happen. As long as this option expires out of the money, I still keep my $175. That was given to me. That's a one and done. I don't have to worry about that. And I also get to keep my shares. So that's one way that you can actually sell options and make some extra money on stocks that you're willing to hold longer term. So make sure you go back and check those videos out on the channel if you want to learn more about how I do that, because it's pretty cool and I think it's very, very beneficial especially for long-term holdings. So again, really quick, going back to the order entry, let's say I want to buy the $10 calls. I come in here, I could do it here, or I could go back to the table form. For me, I'd probably go to the table form. It's easier. I would just like to visualize things with the graph. I go to the table. I go, okay, I want to buy the $10 strike price for SPAQ, making sure I'm going through everything. Expiration date of October 16th. If I want to change that here, I could change that. I'm buying a call, buy. I'm going to buy, let's say I want to buy 2 contracts at a limit price of $4.70. Now, again, when there's the bid and the ask, which I'll talk about really quick, when you have a bid, you have the ask. Again, if you want to get filled right away, you would put your order at the ask. If you want to get a better fill, or you may have to wait for the stock price to come down a little bit or for the premium to come down, put your order at the bid. Or if you want to get filled somewhere in the middle, this may not fill right away, but there's a better chance than putting it at the bid if you put it just at $4.60, for example, in this case. Now, of course, if you want to get filled right away, I would just put it at the ask and move along. If the stock price is moving or it's very volatile and it doesn't hit your fill, your limit price that you're putting here is going to fill you at that price or better. So let's say I put the price at $4.50. The stock starts moving on up. These option contracts start going to $4.80, $4.90. This goes to $4.80. You're going to have to go back and edit that order and move it up if you want to get filled right away, or you could wait for it to come back down to pull back and for you to get filled. And then you'd go in here and you click on place order, and it would place your order and you'd be all set to go. Just make sure you wait for that little notification from Webull saying it filled. And once it fills, you are good to go, and it should show up in your positions tab on the main page of Webull on your account, or on your watch list that you have up on the left-hand side under my positions. So hopefully that video helped you guys out. If you have any questions, make sure to leave them down below. Options trading can certainly be difficult to at least grasp initially, and it's pretty risky. That's why I would recommend starting out with selling calls, selling covered calls if you can. If you can't, I have a bunch of other videos on options trading, talking about some of my experiences, the things I've done right, things I've done wrong. Some of them are pretty old videos, but they hopefully can still help you guys out if you are new. Make sure you go down below, get 2 free stocks with Webull, valued from $8 to $1,600. That is going to be linked down below in the pinned comment and description, like always, as well as there's other resources there that are there to help you guys. If you have any questions in the comments, please, I will be answering those questions. I always see them, even if the video is posted a while ago. I will see those comments. They show up. I get a notification when they do. Please make sure to like this video and subscribe if you guys want to get more up-to-date videos from me, and I will see you guys in the next one.